Most beginners in India start investing with excitement, but very little clarity. They open a trading app, buy a stock someone recommended, and hope it will double quickly. Sometimes it rises for a few days. Then suddenly the market falls. The stock drops, confidence drops even faster. Panic begins. Within a few weeks, many beginners decide something dangerous. They believe investing is gambling. They believe markets are unpredictable. But the truth is very different. Most beginners do not fail because markets are risky. They fail because they start without a structure. No safety plan, no investment order, no long-term system. Imagine trying to build a house but starting from the roof. That is exactly how many people invest. They chase stocks first, instead of building the financial foundation first. So the real question beginners should ask is not, which stock should I buy today? The real question is much deeper. Where should a beginner invest first in India to build wealth slowly, safely, and intelligently over many years? Today, we will walk through that roadmap, step by step, calmly, without hype, because real wealth building is a process of discipline, not excitement. Disclaimer: this video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build a financial safety foundation. Before you invest even 1 rupee, you must prepare for uncertainty. Life in India can change quickly. Medical emergencies happen. Jobs sometimes disappear. Unexpected expenses appear suddenly. If you invest all your money without protection, you may be forced to sell investments during bad market periods. That is how many beginners lose money. So your first investment is not in the stock market. Your first investment is in stability. Create an emergency fund, at least 3 to 6 months of living expenses. For example, if your monthly expenses are 30,000 rupees, your emergency fund should be between 90,000 and 1,080,000 rupees. Where should this money stay? A high-quality savings account or a liquid mutual fund. Safe, accessible, stable. This money is not designed to grow fast. It is designed to protect your life. Once this safety layer exists, investing becomes emotionally easier. You will not panic during market volatility because survival is already secured. Step 2. Start investing using SIP. SIP stands for Systematic Investment Plan. It is one of the simplest and most powerful tools available to Indian investors. Instead of investing a large amount at once, you invest a fixed amount every month, automatically. This method removes the pressure of market timing. Because timing the market is extremely difficult, even professional investors struggle to do it consistently. Example: suppose you start a monthly SIP of 5,000 rupees. You invest this amount in a Nifty 50 index mutual fund. This fund tracks the top companies in India. Companies like Reliance Industries, Infosys, HDFC Bank, ICICI Bank. When these companies grow, your investment grows with them. Over long periods, Indian equity markets have historically delivered around 10 to 12% annual returns. Some years will be higher, some years will be lower. But over long horizons, the economy tends to expand. SIP takes advantage of this growth. When markets fall, your SIP buys more units. When markets rise, your earlier investments increase in value. This process is called rupee cost averaging, and it is extremely powerful over decades. Step 3. Create a simple asset allocation plan. Asset allocation means spreading your money across different investment types. This reduces risk. A beginner portfolio could follow a simple structure: 60% equity, 30% debt, 10% gold. For example, if you invest 10,000 rupees every month, 6,000 rupees goes to equity mutual funds, 3,000 rupees goes to debt funds or fixed income products, 1,000 rupees goes to gold investments. Gold can be purchased through gold ETFs or sovereign gold bonds issued by the government. Each asset plays a different role. Equity creates growth. Debt creates stability. Gold provides protection during uncertainty. This diversification reduces portfolio volatility. Markets move in cycles. When one asset struggles, another asset may perform better. That balance protects long-term wealth. Step 4. Understand risk cycles in markets. Markets never move in straight lines. They move through cycles. Bull markets, bear markets. During bull markets, prices rise quickly. Investors feel confident. But during bear markets, prices fall sharply. Fear spreads everywhere. For example, a 100,000 rupee investment might fall to 80,000 rupees during a correction. This is completely normal in equity markets. Yet beginners often panic at this stage. They sell investments during fear and later buy again after prices rise. This behavior destroys wealth. Successful investors behave differently. They understand that volatility is temporary, but long-term economic growth is powerful. India's economy continues expanding. New businesses are growing. Technology is transforming industries. Over decades, markets tend to reflect this growth. Patience becomes the most valuable investment skill. Step 5. Rebalance your portfolio periodically. Over time, asset allocation changes naturally. For example, if equities grow strongly, your equity allocation may rise from 60% to 75%. That increases portfolio risk. Rebalancing corrects this imbalance. Once a year, review your portfolio. If one asset becomes too large, shift some money into other assets. This maintains balance. It also encourages disciplined investing behavior. You are systematically selling expensive assets and buying relatively cheaper ones. Many professional portfolio managers follow this approach. Simple rules, long-term consistency. Step 6. Understand basic tax awareness. Taxes influence real investment returns. In India, equity mutual funds held longer than 1 year qualify for long-term capital gains taxation. Currently, gains above 1 lakh rupee per year are taxed. Short-term equity gains have a higher tax rate. Debt instruments follow different tax structures. Fixed deposits are taxed based on your income tax slab. Because of this, tax efficiency matters when choosing investments. Some investors use ELSS mutual funds for tax deduction under Section 80C. But remember something important. Never invest only for tax saving. Your primary objective must always be wealth creation. Tax benefits should support your strategy, not define it. Step 7. Avoid common beginner mistakes. Many investors damage their portfolios through emotional decisions. Mistake 1. Chasing trending stocks after large price increases. Mistake 2. Trying intraday trading without proper experience.
Mistake 3. Following random investment tips on social media. Mistake 4. Stopping SIP during market crashes. Mistake 5. Expecting quick profits from long-term investments. Wealth creation rarely feels exciting. It feels repetitive, disciplined, sometimes even boring. But boring financial habits often produce extraordinary results. Consistency is more powerful than intelligence in investing. Step 8. Scale your investments gradually. Many beginners believe they need large capital to start investing. This is not true. You can start with small amounts: 2,000 rupees per month, 3,000 rupees per month, 5,000 rupees per month. The real power comes from increasing investments over time. Whenever your salary grows, increase your SIP amount. For example, 5,000 rupee monthly SIP today, 8,000 rupees after one promotion, 12,000 rupees after a few years. This approach is called step-up investing. It accelerates compounding significantly. Your money begins to grow faster each year. Small increases create large, long-term results.